Well, I don't know if you've heard the news, but Amazon is dead. It's over because AWS has slowed down. In fact, it's not only slowed down to 16% growth rate last quarter, but the Amazon management said it's going to slow down to 11% at one point. 11%. Now, I hope you don't mind. I'm in a different setting here. I'm not at the studio, but I wanted to jump in and react to this news of the great AWS slowdown. So let's go ahead and jump right in. The first thing I want to mention is the trading that happened with Amazon after hours. Like I've said many times, I think it's a good idea to, generally speaking, ignore what happens with the stock price immediately after a company reports earnings. Because in many cases, it's not that instructive. It doesn't really let you know how the company's doing. In this case, Amazon traded up 12% after hours, 10 to 12% at one point. A huge bump in Amazon stock price because the company actually, generally speaking, beat estimates. It came in way above on revenue. It came in $3 billion more revenue than expected, and it beat its earnings. So Amazon's report, top line and bottom line, met and beat expectations, but then something happened. In the earnings call, Andy Jassy at one point answered a question and said that Amazon Web Services grew at 16% year over year last quarter, but it's going to slow down another 500 basis points next quarter. That's their prediction, meaning that it would grow at 11%. When he mentioned that, the stock price dropped 11%, giving up all of the gains it made after hours and even below where it was yesterday. So that's what happened. And this is why I continually say, when a company reports earnings and the stock goes up 10% or down 10%, I would not pay too much attention to that. It's not the most important thing. It's much better to actually look at what's going on, fundamentally speaking, with the company. Now, addressing the news here of a slowdown, I first want to give context to this because this is something that investors seem to be obsessed with. If any part of any business has a slowdown, investors become bearish on the business. This is an article from 2019. 2019, Google had a slowdown in its advertising business. Alphabet had its worst day since 2012 after Google's slowing ad revenue worries investors. Doesn't this sound a little familiar? Google having a huge slowdown and then investors becoming really concerned, selling out of the stock. Lots of people saying that you're dumb to be invested in Google, the company's over. That's what happened right back in 2019. Now, since 2019, Google is up over 100%, over doubling the performance of the S&P 500. So despite all these concerns of a slowdown in Google, the company has still compounded its returns at double the rate of the market. And this has happened continually. If you sold a stock like Google or like Amazon or like Apple, every time they had a slowdown, then you would not own any of these companies for more than a few years because they have slowdowns every couple of years. Before 2019, it was 2016, and then it was 2012. You would have had 3 different time periods to sell the company that would have been one of the best investments over the past couple of decades. Now, we have an earnings report coming up for Apple. I'm sure there's going to be parts of Apple's business that slow down this next quarter. That's going to be doom and gloom for Apple. Their iPhone sales or what have you is going to slow down. I've been investing in Apple for over 5 years, and during that time period, I've heard investors talking about the great Apple slowdown year after year after year. You become numb to it after a certain point because these compounder companies like Google and Apple continue to make incredible gains despite people saying that their businesses are slowing down. So that's the first thing. If the business is having a slowdown, put it in perspective. Don't have any type of huge reactions from one company having a slowdown in one part of its business. The next thing I want to address is AWS specifically. A lot of people are trying to paint the picture like this is an AWS only issue, like AWS is doing so much worse than Google Cloud or Microsoft Azure. And that's just not the case. Look at this chart here. It illustrates it quite well. What company has really slowed down over the past 5 years more out of these two? Has AWS slowed down the most, or has Microsoft Azure? Sure, AWS slowed down more over the past 2 quarters. So if you're zoomed into just a 120-day period or a 90-day period, AWS slowed down more. But look at it on a bigger picture. Over the past 5 or 6 years, on a much longer timetable, Microsoft Azure is actually slowing down faster than AWS. And even if we look over just the past year, does this look all that different? Here's Microsoft Azure going from 46% growth rates to 27%, and then AWS going from 40% to 16%. The story here is that cloud is slowing down. Azure is slowing down, Google Cloud Pro is slowing down, and AWS is slowing down. The entire market of cloud is slowing down. The reason being that companies in the Fortune 500 are trying to optimize costs, cut back on developers, and they're trying to slow down their cloud spend. So this is having an overall impact on these big companies. So the point here is that this is not an AWS specific issue. This is a cloud issue. The whole business is going through a cyclical slowdown. In my opinion, I do not believe this is going to be a long-term concern for these companies. It is a short-term concern because the fact that every business is trying to optimize currently. Now, if we look at the other parts of Amazon's earnings report, we have the segment breakdown here. And aside from what a lot of investors try to tell you, AWS is only one part of Amazon. There's a lot of other businesses that are very important intrinsic value drivers of the company. So let's go ahead and go through some of this here. The first thing I'll note is that the online sales, their first party sales, didn't grow at all. It grew 3% constant currency, which is incredibly slow. This is a good thing for Amazon. They do not want their lowest margin part of their business to be their biggest growth driver. Instead, they have this other much higher part of their business, the third-party seller services, growing at a pace of 20%, 20% year over year. That is very fast growth for that part of their business. So the low margin part of their business is growing slowly. The high margin part of their retail business is growing quickly. Then we get to another high margin part, these subscription services. This is growing at 17%. Moving on, we have one of the pillars of core intrinsic value driver of Amazon, which is the advertising. Advertising's very high margins. They have not revealed the margins directly, but based on Meta's, it's much higher margins than the rest of their business. And they grew it at 23%. Compare that growth, 23%, to Google or Meta. See what company's growing advertising quicker. So a lot of people focused on AWS compared to Azure and Google. Compare advertising to Google and Meta. This part of their business is a huge intrinsic value driver, and it's growing at a very rapid pace. And then finally, we get to AWS, which, like I said in my earnings prediction video, this was going to be a sad part for the company. And this is something we should have expected going into the earnings report, that AWS was going to slow down. And again, in my opinion, I believe that this is a temporary thing. Like all of these companies, Apple, Google, Meta, all of them have parts of their business that are a little bit more cyclical than others. AWS and cloud hosting in general is going through a cyclical part of the business cycle where every Fortune 500 company is wanting to cut down on costs. So overall with Amazon, there's 3 different intrinsic value drivers for the company. AWS is one of them. That's going through a slowdown, but there's also the advertising business that's growing faster than expected. That's very high margin. That's a $40 billion business. Amazon's ads are huge. And then there's the third-party retail segment, which is also very high margin, which has the prime businesses and seller services on top of it, which also is growing 20% year over year. So overall, I actually like this report. Me personally, I'm not concerned at all about it. I know that cloud hosting is going to be around for decades. I don't think it's a problem that's going to slow down in 2023. But if you're more short-term, if you're concerned about the next 3 months, then I don't know what to tell you. That's not the game I'm playing. But this is my thoughts overall. Thought I would jump in and give you my review of this earnings report. I'll see you in the next one.